A notable change is quietly taking place within the UK's investment landscape. The relentless enthusiasm for Nvidia, the American chip maker at the heart of the artificial intelligence revolution, is beginning to face a dose of British caution. Investment trust managers who oversee vast pools of capital for retail clients, institutional clients are starting to trim their holdings in the high-flying stock. This move is not a dramatic exit, but a calculated and strategic reduction of their exposure. It signals a growing unease among some of the UK's most seasoned financial stewards, suggesting that the era of unchecked optimism for Nvidia's stock price may be entering a more sober and reflective phase. This shift matters because these managers are often seen as indicators of broader market sentiment. Their actions can influence market dynamics far beyond their own portfolios. Instead, it stems from a more immediate and practical concern: the stock's meteoric valuation. After an unprecedented surge in its share price over the past 2 years, some UK managers now believe the risk of a correction outweighs the potential for further explosive gains in the short term. For example, some prominent UK global equity trusts have cut their Nvidia positions by as much as 20% in the last quarter alone, a significant move for a stock that has been a primary driver of their performance. This deliberate step back highlights a classic investment dilemma. When does a wonderful company become a dangerously expensive stock? The answer for a growing number of UK professionals appears to be now. This cautious stance provides a fascinating counterpoint to the global narrative, which has largely remained overwhelmingly bullish on Nvidia and the broader AI theme. While retail investors and many overseas funds continue to pour money into AI-related equities, a distinct sense of risk management is emerging from London's financial district. The decision to take profits and reallocate capital is a disciplined one, often governed by strict internal mandates that prevent any single stock from dominating a portfolio too heavily. These actions are a reminder that professional investing is not just about identifying winners, but also about managing risk and protecting gains. The tempered approach of UK trusts could therefore be an early warning sign that the market's collective psychology is beginning to evolve. The implications of this subtle but significant pivot are widespread. It raises important questions for individual investors who may have followed the hype train into Nvidia and other technology giants. If the so-called smart money is starting to apply the brakes, should others reconsider their own positions? This development underscores the growing divergence between the technological narrative of AI and the financial principles of valuation and risk control. As we stand here on October 24, 2025, the actions of these UK fund managers serve as a crucial case study in the ongoing tension between market momentum and investment discipline that will likely define the next chapter for global equity markets and the technology sector at large. To fully appreciate the significance of the current caution, one must first understand Nvidia's monumental rise. The company, once primarily known among video gamers for its powerful graphics processing units, has become the undisputed hardware backbone of the artificial intelligence revolution. Its advanced chips are not just good at rendering graphics. Their parallel processing capabilities make them exceptionally well suited for training the large language models. Complex AI systems that have captured the world's imagination. This unique technological advantage has placed Nvidia at the epicenter of a transformative technology shift, making it an essential supplier for nearly every company racing to build AI capabilities. From tech giants to emerging startups, the financial results of this dominance have been nothing short of staggering, fueling the massive investor inflows that have defined the last 2 years. The demand for its H100 and newer generation GPUs has consistently outstripped supply, allowing the company to command premium prices and achieve unprecedented revenue growth. In one recent quarter, Nvidia reported a year-over-year revenue increase of over 250%. This explosive growth cemented its status as a market darling and a core holding for global growth funds, including many based in the UK. For a time, Simply owning Nvidia was one of the most effective strategies to outperform benchmarks. The story was simple and compelling. As long as the AI boom continued, Nvidia would reap the rewards. Its market share in the data center AI chip market has been estimated to be well over 90%, giving it a near monopolistic position on the industry's most critical resource. This dominance attracted a flood of capital, pushing its market capitalization into the trillions. Investing in Nvidia became synonymous with investing in the future of technology, which is precisely what now makes some professionals nervous. The company's stock became a must-own asset, lifting entire market indices. But the concentration of success created a concentration of risk within portfolios. As the stock soared, it came to represent a larger share of any fund that held it, forcing managers into a difficult position. Sell and risk missing gains, or hold and risk significant downside if sentiment turns. This predicament has led many UK trust managers to re-evaluate their relationship with the AI behemoth. At the heart of the growing caution lies a single powerful concept: valuation. In simple terms, valuation is about determining what a company is truly worth and comparing that intrinsic value to its current stock price. A stock is considered expensive when its price is very high relative to its underlying earnings, sales, and future growth prospects. For Nvidia, the stock price has risen so far, so fast. Many managers now question whether it has detached from these anchors. They worry the price reflects not just excellent performance, but also unsustainable hype and speculation. This is the classic fear of a bubble. A common lens is the price-to-earnings ratio. How many dollars you pay for each dollar of annual profit. While Nvidia's earnings have grown spectacularly, its price has grown even faster. At its peak, the stock traded at a forward PE multiple of over 40. High-growth firms can command high multiples, but this is well above broader market and many tech peers. For risk-conscious UK managers, the margin for error is razor-thin. A lofty valuation leaves no room for disappointment. Any hint of slowdown in demand, increased competition from AMD or Intel, or a macro shift could trigger a sharp correction. The response from UK investment trust managers has not been a panicked sell-off, but a series of deliberate, measured actions. The most common strategy has been trimming, selling a portion of their Nvidia holding to lock in some of the extraordinary profits they have made, reducing risk without completely exiting, while still believing in the long term. This rebalancing is fundamental to portfolio management. As a successful stock grows too large, managers sell it down to align with risk rules and strategy. A clear example is the Scottish Mortgage Investment Trust, which has actively reduced its Nvidia stake over recent months, bringing it down from over 8% towards 6 to 7%. A 1 to 2 percentage point trim in a multi-billion pound fund equals hundreds of millions sold, a conscious de-risking. We remain positive on the long-term structural growth story of AI. Nvidia is a phenomenal company. However, as disciplined investors, we take profits when a position has performed exceptionally well and its valuation appears stretched. Our controls won't let any single stock dominate the portfolio. The cautious UK stance contrasts with exuberance elsewhere, especially US markets and retail investors. Commission-free apps and social media have fueled FOMO into Nvidia and AI stocks. Momentum and narrative often outweigh traditional metrics. UK managers face fiduciary duties emphasizing capital preservation and long-term risk-adjusted returns, including protecting in downturns. Institutional memory in London runs deep. Veterans recall the dot-com bubble and painful crashes when narratives outran valuation. UK commentary now stresses concentration risk, competition, and semiconductor cyclicality, producing a more balanced tone. The result is a growing divide in global approaches to the next phase of the AI investment story. UK investors are not anti-AI. Enthusiasm is simply tempered by pragmatic realism. The actions of large UK investment trusts can reverberate beyond their borders. Systematic selling increases available supply and can create price headwinds despite Nvidia's huge daily volume. Short-term volatility can rise as markets digest signals from long-term holders, reducing exposure. Sentiment shifts ripple to other AI names. Semiconductors, AI software, data centers. Trimming could signal that the easy money in the AI trade has been made, prompting sector-wide reassessment. Unlocked capital must be reallocated, potentially boosting less hyped areas like healthcare, consumer staples, and value stocks. This late-cycle rotation from expensive growth to cheaper, stable names can shape performance in coming months. It reminds us prices do not rise in a straight line, and even revolutionary companies face financial gravity. A more balanced debate about risks and rewards is a sign of a maturing market, healthier for long-term investors. Short-term volatility may rise, but discipline improves long-term outcomes. To truly understand the dynamic, a simple chart helps. Imagine a dual-axis line chart from early 2024 to October 2025. Left axis, Nvidia share price. The blue line climbs steeply, peaking recently. Right axis, average Nvidia holding in UK global trusts. The red line starts near 5 to 6%, rises early, then plateaus and dips over the last 6 months, even as the blue price line climbs or holds at a peak. The widening gap visualizes price performance versus institutional positioning. Caption: diverging paths, Nvidia's share price versus UK trust holdings. It is data-driven confirmation that as valuation stretched, managers reduced exposure. A concise reality check any investor can understand at a glance. Looking ahead in late 2025, two primary scenarios emerge: tension between long-term potential and a high current valuation. First, the cautious downside. Valuation concerns prove justified. A mild spending slowdown, a viable competitor, or a broader downturn causes Nvidia to miss lofty expectations. Momentum fades, the multiple contracts quickly, and a 30 to 40% drop from the peak would not be out of the question, even if the business remains fundamentally strong. Trimmed UK trusts would have protected a significant portion of client gains, a reminder that great companies can be poor investments at the wrong price. Second, the long-term upside. AI accelerates faster than expected. New applications drive another demand wave. Nvidia defends market share, maintains margins, and keeps innovating with next-gen products. Earnings growth could grow into today's valuation, making the current price look reasonable in hindsight. Some liken AI to the Industrial Revolution or the Internet, so trimming rather than selling entirely lets managers participate in upside while hedging downside. In conclusion, the decision by more UK investment trust managers to tap the brakes on Nvidia is a rational response to an extraordinary market phenomenon. It is not an indictment of Nvidia or AI, but a calculated pause to rebalance risk after unprecedented gains stretched valuation. This is professional fund management in action, protecting and growing client capital responsibly. It highlights the tension between a compelling long-term story and the immediate risk of an expensive price. The data-driven divergence between Nvidia's soaring price and declining UK trust holdings grounds this shift, in fact. Key takeaway: pay attention not just to the story but also to the price. Watch valuations and avoid single-position dominance. As the AI era unfolds, balance belief in the future with respect for present-day risks. Prudence is the word of the day. Pay attention to the story and the price.